Okay, good evening and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're going to be embarking on our first intermediate options trading course. And we're going to cover something that I think is one of the most important topics for traders to understand and learn that's outside of learning about the markets, learning about strategy, and learning about options. And that's really your trading psychology. And it's extremely important in understanding why trading psychology is important for the perspective of risk and money management. So we're going to dive into some of the ways to change your view of thinking when you're thinking about your trades, when you're thinking about winners and losers and how to handle those types of emotions, if you will, that generally comes into play when you're trading options, and then give you a different way to think about how you approach the way that you think about each individual trade, and then the way that you think about your overall trading account. So a lot of things that I want to unpack here and cover with you here today, but this really, I would say, summarizes my experience of working as a market strategist over the last 13 years, working with both retail and institutional clients. I have worked at this point with thousands of traders. I have worked with traders from the absolute beginners to very experienced options traders, and from all different asset classes, both retail and professional. And what this really summarizes to, from my perspective, is what makes successful traders stand out from the rest is how they think about their trading, how they think about what type of, I call it a game, and you'll see why here in a second, but it's really important to understand what type of game are you playing, because that helps you understand how you think about your losses, how do you handle your losses, and how do you continue to move on from those losses to move on to your next trade. Because many times I see a lot of traders get they get hung up on winning, and that really, in my opinion, is the destruction of many, many traders. So those are the things I want to discuss with you here today, talking about trading psychology. And then what we'll do is we'll break down the math behind why we want to use certain types of risk and money management techniques in our portfolio. So let's go ahead and get started. Before I do, even though we're not really going to talk about any specific trades here today, but any trades that we do discuss is purely for demonstration purposes and is not a solicitation to buy or sell any specific securities. So let's go ahead and get started. First of all, this is just a quick disclaimer for those of you that have access to OptionsPlay. You get access to it completely free of charge. But for those of you that are first-time viewers here, I highly recommend you to sign up for this tool. It's a completely free of charge for everyone. It gives you access to the OptionsPlay platform, gives you access to our options education webinars like the one that you are on right now, as well as a full video library for you to access the previous recordings. Now, this is our first intermediate options course. We've already started 2 beginner courses for 2020. So if you're brand new to options trading, this course is actually suitable because it doesn't require any options experience to learn about trading psychology. But if you want to learn more about options trading in terms of getting started, I highly recommend you to look at our video library or our education page, which includes the recordings for our beginners options course that will cover everything from calls and puts to buying calls to selling calls and puts, all of that to help you get started. So let's go ahead and start our topic here today. So like I said, today is the first intermediate options trading course. We're going to be talking predominantly around trading psychology. Then we'll talk a little bit about the risk and money management rules for options trading. Now, we do have a couple of upcoming events. So in a couple of weeks, on May 27th, we're going to be talking about optimal expiration and strike prices. A lot of clients ask us, how do you pick the right expiration date when you're trading options? How do you pick the right strike price? So we're going to talk about an overarching design as far as how do you approach what is the best expiration date and strike price to choose. That's going to help you design your different strategies. And then what we'll do is we always follow these up with live Q&A and a live market analysis where we help you apply what we've learned during a session where we don't teach anything. We really just look at symbols together and we answer your questions. So that's going to be coming up on May 27th and June 10th. So I'm looking forward to having everyone there. So let's go ahead and get started. I'm going to first start by talking about an example that I think many of us can relate to. And this is where we get attached to a trade. And I want to talk a little bit about why we get attached to a trade and how we can potentially change our thinking to prevent this, or what can we do to change with our trading rules that can help us prevent this. So I'm going to start by an example, right? Where first you have a chart here, you have a stock, it's trading, it breaks above its resistance level. You see that it kind of bounces off that resistance level multiple times. You see it bounce off again. So you're thinking, oh, it's time to buy. So you buy the stock. It's a good trade to make, but instead of going higher, the stock starts to move lower. So what happens then, right? You buy a stock, the stock goes up a little bit, but then starts to move lower. Many times what I see from many investors is they start to try to justify their original trade and see if maybe they can find another way to get back to break even or get themselves back to winning on this particular trade. So after the trade starts to go south, you start looking back at the chart again. You kind of forget the fact that you bought it because it was near a support level. You start looking back and you say, oh, there's a new support level around here, around 22, that it looks like it's about to bounce off of that. So maybe if I buy some more of this stock, the stock will bounce a little bit more and I can get myself back to break even, maybe even a small profit. But what ends up happening is that the stock continues to move lower. And then what you start doing is you start finding new justifications for this particular trade, where you might be saying, well, now it looks like if you look at the technical indicators, this stock is severely overbought. So it must be time for a bounce higher. So you think about, well, maybe if I just buy some more and the stock bounces back to here, I'll get myself back to break even. And instead that doesn't happen. The stock continues to decline. And now you say to yourself, well, this stock's been oversold for so long, it's got to bounce. So you buy some more and then you get a small bounce, but the stock continues to move lower. And next thing you know, you've risked substantially more money than you originally intended on that first particular trade. And you kept buying and buying and buying as the stock kept going down. And then you end up losing substantially more money than what you originally intended. Now, if anyone can relate to something like this in your own trading, please type yes into the chat window. You can find your chat window at the bottom of your screen. But if you find yourself ever in this type of scenario where, you bought a stock, the stock went against you, and as the stock went against you, you still continue to try to justify a way to get back into that trade, whether it's adding on to that trade or just continue to hold on, hoping that the trade comes back. I think many of us can relate to this, right? Now, from my perspective, there's two primary reasons why traders find themselves in this particular environment. Number one, it's this attachment to being right or winning. And this is something we want to discuss heavily here, right? Because why do we trade? We want to win, right? We want to make profits. So we never want to be wrong. So many times we get this psychological attachment to being wrong, and that we want to avoid being wrong at all times, because being wrong means that we are losing money, right? But I think that this is really what I want to help everyone understand, is that there are two types of things that you need to think about. You need to think about your individual trades, and then you need to think about your trading account. And many times when we're doing this, we're only thinking about that individual trade. We completely forget about trading account. We forget about how much risk we're taking in our overall account. This is the first reason why I find many people doing this, is because they're focused on that one trade and they're not focused on their general account. Number two, the reason that we tend to find people doing this is because they risk too much money in the first place. This is what poker players call pot committed, where basically you've risked so much money already on this particular trade, you can't really afford for this trade to go wrong. So what you do is you do everything you possibly can to get yourself back to break even. Similar mentality to sometimes when you see gamblers, losing a lot of money, trying to borrow money to get themselves back to break even. It's a similar type of psychological effect, where instead, if you risk a small amount of money, chances are you don't have such a big problem of letting that loss go. But when you risk too much money, sometimes it's too much of a hit to your account for you to just accept that loss and move on to the next trade. So that's my what I've noticed as a strategist working with clients from the last 13 years as to why we psychologically do this to ourselves and end up potentially blowing up our account. So again, if any of you can relate to this or have found yourself in a position like this, please type yes into the chat window, because I think anyone who's traded for any particular amount of time can relate to this and found themselves in a scenario like this. So today what we want to do is we want to talk about how can you think about your trading account to potentially help you avoid these types of scenarios. So first, what I want to talk a little bit about is trading psychology. And the reason that I'm bringing this up is because of the questions that I get asked day in and day out. I get types of questions. I get dozens of emails a day from users asking me these types of questions. Number one, how do I repair a losing trade? And what that tells me is that people have this aversion to losing, as if losing is something that they should avoid at all costs. And psychologically, that makes sense, right? No one wants to lose on a trade. That means you've lost money. No one wants to lose. But the one thing that you need to start realizing is that losing is part of trading. You can't possibly just always win. And once you change your thinking on this, and I'm going to give you some pointers as to how you can change your thinking on this, that's really where I think people turn the corner from struggling as traders to becoming more successful as traders. Another question I get asked a lot is, how do I make my money back on a losing trade? This tells me, again, people have this risk aversion to losing, and they constantly try to win all the time. And this is really what I think causes most people to lose actually in the long run, is this attachment to trying to win. I also get a lot of questions asking, what percentage of your trades are winners? As if somehow that if your winning percentage was greater, that you would somehow make more money. And I think that is probably one of the biggest fallacies of trading, that if you just win a lot or have a large percentage of your trades to be winners, that you'll be profitable. I can't help enough to say that you could win 99% of the time and then blow up your entire account on that one losing trade. Is that a successful trade? Is that a successful trading account? Absolutely not, even though you can claim that you've won 99% of your trades. It doesn't matter what percentage of your trades that you win. You can actually win 30% of your trades and still make money, because the 30% of the time that you win, you hit home runs and you make really big successful trades. And the 70% of the time that you lose, you have small losers. Now, that is a bit of an extreme example, but there are plenty of examples of successful traders that only win 50-55% of the time, but the times that they win, they're winning, they have a larger gain on their trade than the trades that they lose on, because they are very focused on managing risk. I also get comments from people, sometimes when they follow my trade ideas, where they say, you've had 3 big losses in a row, your trading is terrible. That also tells me, again, this just tells me the psychology that people have, attachment to winning, attachment to always being right, that actually becomes your downfall in trading. So what I want to point you to is a piece of writing from a fellow called James Carse. Now, James Carse is not a finance professional. He has no trading background. He is actually a religious philosopher, but he wrote a book in 1986 called Infinite versus Finite Games. And if any of you have studied game theory, there are also plenty of books now written on management that use this type of theory of infinite versus finite games. That helps people frame not just trading, but a lot of other things in our lives. But I think it is a great book on understanding the psychology of it. I think is really important, that differentiates between what I think are successful traders and everyone else, because successful traders realize that they're playing an infinite game, while everyone else thinks that they're playing a finite game. So the question becomes, are you playing the right game when you're trading? Okay, and we're going to break this down as to what's an infinite game, what's a finite game, and how it applies to trading. So James Carse wrote this book, and I don't necessarily recommend that you read the book. There are plenty of other books that are written since then that apply his theory to different things that I think are much better for reading. And there are plenty of great YouTube videos if you just Google finite versus infinite games, if you want to learn more about this. But it's fairly simple. A finite game is a game where you have defined players and observers, and there are fixed rules to the game. The game will end at a certain point, and at that certain point, there's declared a winner or a loser. So think about games like basketball, football, soccer. All of these games are an example of a finite game where you know who's playing, you know who's observing, you have a set of rules, there's an end to the game, and at the end of the game, there's winner and a loser. So examples of this are soccer, basketball, even playing like blackjack at a casino. You have a winner, you have a loser, you have fixed set of rules. Chess is an example of a finite game. This is, I think, a pretty simple thing to understand what a finite game is. Now, on the flip side, what's an infinite game? An infinite game is a game where you have known and unknown players, where you don't exactly know who's part of the game. There are no agreed upon rules, meaning there isn't a set of rules that you have to abide by, and the game never ends. There's no such thing as the end to an infinite game. And guess what? In an infinite game, there's no such thing as winning, and there's no such thing as losing. There's only two possible outcomes. You are either a player in the game, or you drop out because you can no longer stay in the game. So think about trading, right? Which one does trading do you think falls under? And the answer is that trading is actually an infinite game, because when you're trading, there are no rules to trading. There's no such thing as winning in trading. There's no winners in trading. There's no losers in trading. There are only traders that still have money in their account to continue trading, and there are traders that have blown up their entire accounts and no longer have enough money to continue trading unless they deposit more money. Now, that is very different than each individual trade that you make, which actually falls under the finite game. So there are plenty of scenarios where you're playing a finite game inside of an infinite game. So an example like this is, for example, blackjack, right? So when you play blackjack, that is a finite game. There's a defined set of rules, and there's a clear winner and loser at the end of it. But think about running a casino. That is an example of an infinite game. Because guess what? There's no such thing as winning in running a casino. Yes, you are playing blackjack games all day long as a casino, but there's no such thing as winning. You can either continue to operate a casino because you are good at operating a casino, or you're bad at operating a casino and you lose more money to the players and you drop out. So if you think about trading, trading is kind of like operating a casino, where each individual trade that you make is a finite game, because at the end of each trade, you can either win or you can lose. But that's not what's important. What's important is your trading account. And guess what? There are two possible outcomes for your trading account. You can either have sufficient funds to make another trade, or you could blow up you can have a single trade blow up your account and not have enough funds to continue trading until you deposit more money. And that's the game that you're ultimately playing as a trader. You should not be focusing on winning. You should be focusing on staying in the game. You should be preventing yourself from dropping out. How do you prevent yourself from dropping out? By focusing your entire trading career on managing risk, not on winning, but on managing risk, meaning at all costs, preventing yourself from blowing up your account and exiting the game. Does that make sense to everyone? So please type 1 into the chat window if that makes sense, because the way that I hear everyone ask questions, or generally what I hear from traders when they ask me, what percentage of your trades are winners? How do I make money? How do I make my money back on a losing trade? How do I repair a losing trade? What that tells me is that you're thinking about a finite game. Yes, each individual trade is a finite game, but what you're really concerned about is the true long-term infinite game, which is managing your portfolio and making sure that you remain in the game to continue trading. An example of this is like starting a business, right? Starting a business, there's no such thing as winning, right? Think about Apple versus Microsoft. They are playing an infinite game where there's no such thing as Apple winning or Microsoft winning. It just plays until one player dominates the other player so much that the other player has to drop out or claim bankruptcy or whatever that is, right? And your job as a trader is to avoid that at all costs. How do you do that? Not by focusing on winning as much as possible, certainly not by saying that I want to win 99% of the time. You stay in the game by managing risk. And that is truly what makes the difference between what I consider a successful trader and everyone else. Because successful traders don't worry about how much money they're necessarily making. They're constantly worried about how much risk do I have in the market? How much risk am I taking at each individual time? And am I risking blowing up my account where I can no longer afford to continue trading? Because professional traders that do this for a living, that's their whole livelihood. That's why they protect their portfolios, is their number one goal. And when you think about trading, and this is really some of the things that I think many traders that have not learned this yet focus more on the infinite game. But once you realize this, and you realize that you are the finite player, that you are the finite player playing in an infinite game, what that leads up to is a lot of frustration, because you're constantly trying to win at something that there's no such thing as winning. There's no such thing as winning in trading, but you're constantly trying to win at something that you can't win. And that leads to a lot of frustration. And only when you realize that you are an infinite player inside an infinite game is this where you advance as a trader. Now, this, for some of you, may be a completely new revelation and a completely new way of thinking. So for those of you that find that this is a completely brand new concept, I highly recommend that after we finish here today, you go on YouTube, you go on Google, you Google this concept of infinite versus finite games, and you can see how many different things in your lives this applies to, because it is not just trading. There are plenty of things that you can apply this theory to. In game theory, this is really something that's heavily used in how foreign powers consider, what each country is going to make their next move. These are the things that they think about. So I highly recommend, if this is a brand new concept to you, start thinking about this and start doing a little bit of research, because the question that you should be asking yourself is, are you focused on staying in the game, or are you focused on winning? Because if you're focused on winning, you're focusing on the wrong thing. If you're focusing on staying in the game, that's when you've changed your thought process, and that's how you can prevent yourself from blowing yourself up and continuing to do this. Because at this point, if you could just accept the fact that, hey, guess what? I'm wrong. There's another trade that I can make down the line that I might be right on. I can let go of that loser, and because I'm concerned, my biggest concern is protecting my portfolio. So the second I have a loss where I thought this was a support level and I was wrong, then I simply let that go and I find the next opportunity. I'm not attached to this particular trade, because guess what? It doesn't matter that I win on that trade. What matters to me is that I don't blow up my portfolio. And if I keep doing this and this and this and this, that's how I blow up my portfolio. Okay, so if that makes sense to everyone, please type 2 into the chat window. So that begs the question, what does staying in the game even mean, right? So in an infinite game, your goal is to stay in the game. What does that actually mean with respect to trading? And this is some of the things that we're going to go over here today, is how do you actually, stay in the game? What can you do to your portfolio that allows you to stay in the game? And realize that you're playing an infinite game, and switch your focus from winning to staying in the game. So, and that really comes down to protecting your portfolio, protecting your trading account at all costs. So now that we understand this theory, right? Now that we understand this concept, what I want to do is I want to talk to you through the math and the actual steps that you would take to apply this for your portfolio. So what we're going to do is we're just going to tell you the rule. It's really simple. And we're going to start off by telling you the rule, the golden rule of risk management. Then what we're going to do is we're going to work our way backwards to show you the math behind why the golden rule applies for your trading account. In order to do that, we have to learn a little bit about linear versus exponential functions. I've historically found that this is a somewhat difficult topic to many times to grasp, but in our COVID-19 days, I think most of us have learned more about exponential functions than we probably care to, but that also means that we are a little bit more aware of the power of an exponential function as we understand how a disease spreads. And it's so powerful, and it's so important in understanding why the golden rule of risk management applies. Then we're going to talk about your high watermark. We're going to talk about preventing your blowing up your accounts. We'll talk a little bit about the math behind consecutive losses, because guess what? As a trader, you're always going to find times where you're just going to be wrong on a series of trades back to back. You're going to be wrong on the one trade and the next trade and the next trade, and you have just a series of bad luck. The same way how you can flip a coin and have 10 heads in a row It's rare, but it can happen. And that's reality of trading. So we're going to talk about how to handle consecutive losses, how to think about consecutive losses, how to make sure that those consecutive losses that you have do not blow up your account. And then we'll show you some of the risk and money calculators that are already built into the tools that are available to you here at OptionsPlay to help you leverage these things. So first and foremost, just starting off very simple, the golden rule of risk management is simply never risking 1 to 2% of your entire portfolio per trade. So depending on what your portfolio value is, so whether you have a 5,000 crown portfolio or 100 or a million crown portfolio, you never want to risk more than this particular range for each individual trade. Now, this is predominantly for options. Now, you can adapt this for stock trading. I tend to find that if you're only trading stocks, that you could get up to roughly about 5% of your portfolio per stock investment. But generally speaking, if you're trading options, you want to stick to somewhere in this 1 to 2% range. For stocks, you can go up to roughly about 5% per stock purchase, okay? But right now we're talking about more about options. So your general rule of thumb is that you want to stick within 1 to 2% of your entire portfolio per trade, okay? And what we're gonna do is we're gonna work our way backwards to understand why 1 to 2% is that magic number. And in order to do that, we really have to think about linear versus exponential functions. And one of the things that we learned from COVID-19 was really that exponential functions at first basically don't, on the surface look like they don't even exist, because a linear function makes it very clear to itself from the very beginning. An exponential function really creeps up on you because at first it grows extremely slowly for a long period of time where it's almost completely unnoticeable. And that's why so many countries were so late in reacting to this, because they simply said, we don't have any cases. That's what we did here in the US. We said, you know what, there are only 2 cases up until, late February, when there clearly were probably thousands and thousands of cases. But because it's just how exponential functions work, is that at first it multiplies at such a small rate that it's unnoticeable until it becomes too late, and then it just skyrockets, right? That's the power of an exponential function. So how does this apply to trading? How does this apply to your portfolio? And it comes down to a few different charts. Number one, I'm going to show you the chart that shows you what it takes to get yourself back to break even, meaning after a loss, how much do you need to gain to get yourself back to where you had originally started? So when you have a 10% loss, you only need an 11% gain to get yourself back to break even. So roughly the same return to get yourself back to break even. Now, if you lose another 10%, you need 25% to get yourself back to break even. Again, a little bit more, but not noticeably more. But then as you start getting into the 30s and 40%, it gets to a point where it's almost unmanageable, because at 30%, you need a 43% return just to get back to break even. Think about how many years that you've had a 43% return in your trading account. I would say that it's pretty rare for most people to have a 43% return, but how many years do you have a 30% loss? I certainly think that many people have seen 30% losses far more often than they've seen a 43% return to get themselves back to break even. So even at 30%, it becomes fairly unmanageable to get yourself back to break even without depositing more money. As you get to 40 to 50%, you're pretty much at insurmountable odds at this point, meaning it would probably take you 2 to 3 times the amount of time to get yourself back to break even if you exceed somewhere in this particular level. So if you have losses greater than 40%, you will generally, if you're not depositing more money, you will generally see that you'll need 2 to 3 times the amount of time it took for you to lose that amount of money to get yourself back to break even. So anything above 30% or so becomes very difficult to get yourself back to break even. So going back to our concept of playing an infinite game, when you're playing an infinite game and your goal is to stay in the game, guess what? In order to do that, what you have to do is really prevent your portfolio from ever suffering losses greater than roughly 25%, because anything greater than 25% is really difficult to get yourself back to break even. And that's why you need to focus on losses and think about, not just think about the current trade that you're in, but think about all the other trades that you're planning on making that by expiration, are you risking 25% of your portfolio? Because sometimes we just think about individual trades. We have to also think about all of the trades that we're spreading across our portfolio. So those are some of the things we're going to cover. But first and foremost, the amount that it takes to get yourself back to break even, that amount grows at an exponential function. And at first, it's not really noticeable. But once you get past a certain point, it becomes impossible to overcome. So does that make sense to everyone? Please type 3 if that makes sense, and why it's so important that when you're managing your portfolio, you need to realize that the threshold here is roughly around 25%. And if you exceed it, difficult to get yourself back to break even. So you will want to do at all costs to stay on this side of that line, okay? So how can we do that? Now let's talk about the number of trades that it takes to blow up your account. So let's say you risk 10% of your account per trade. And I know, given the number of people that are here on this webinar, there's at least a few people here who have exceeded risking 10% of their portfolio on a single trade. If you've found yourself in that scenario, please type 4 into the chat window if you've ever risked more than 10% of your account per trade on a single trade. All right, and I know there's a few of you, and it's okay. It's unfortunate, but I call it tuition with respect to trading. Is losing money, we call it tuition. You have to do it in order to learn how to trade. If you don't lose, you're never going to learn. But as you can see, if you risk 10% of your account per trade, right, then you can have 10 consecutive losses in a row before you've blown up your entire account. If you risk 9%, you can risk 11 trades, right? 8%, roughly 13 trades. And then, and what happens is that the growth here in terms of each 1% that you risk less, at first, it's not really as noticeable in terms of how many more trades that you can make. But as you get closer and closer to this end of the spectrum, this starts to grow at an exponential function. At 2%, you need 50 consecutive losing trades to blow up your account, or 100 consecutive losing trades to blow up your account within that 1 to 2% zone. So this is really where you want to be, because it really would take an astronomical number of losing trades in a row for you to blow up your account. So this is one of the easiest ways to prevent yourself from blowing up your account is to trade small. You can trade a lot of different trades, but each one trades small, so that each individual trade does not risk getting yourself to that point where you've risked 25% of your account, okay? So that's first and foremost, is trading small, because by trading small, you exponentially grow the number of trades that it would take in order for you to get to a point where you've blown up your account or exceeded that 25% threshold that becomes difficult to get yourself back from. So that's this, I think, is pretty simple to understand, but just to check, please type 5 into the chat window if this makes sense to you. And that's why, generally speaking, you want to stick to that 1 to 2% of your account. Okay, perfect. I see a lot of 5s. So now that we understand each individual trade, so that's thinking about the finite game. Now let's think about your overall trading account, which is the infinite game, which is the more important game to focus on. So whenever we're trading, we have a series of trades. We don't just have one trade or 2 trades. We have hundreds, potentially thousands of trades throughout your trading career. So we want to think about that from the thousands of trades perspective. So what I have here is a chart of your win rate. So I would say on the low end of the spectrum, if you're an options trader, if you're only buying calls and puts, you might see win rates in the low, in the 30s, 40% range. If you're selling options, if you're selling credit spreads, if you're selling out of the money options, if you're selling out of the money calls, out of the money puts, you might find yourself, your winning percentage to be on the higher end. Now, keep in mind, when you have a low win rate, you many times have a very good risk to reward, where you might be risking, for every 100 crowns, you might be making, let's say, 300 crowns for every 100 that you're risking. But if you're trading these 70% winners, if you're trading strategies that have these very high probability of winning, many times what you're doing is for every $100 in reward, you are taking on roughly $300 in risk. So many times I see traders will ask me, how do I find strategies that give me this? How do I get 70, 80, 90% winners? And I always tell people, if you only focus on probability, you've completely lost track of what's really important. What's really important is not what your winning percentage is, but how much money are you making in the long run? Meaning, how much money are you making each time you win? How much money are you losing each time you lose? And then multiply that by your win percentage, because that's the only thing that really matters, because you could win 70% of the time and still lose money in the long run, and that doesn't help you at all. So just focusing on probability or trying to find high probability trades many times, I think, is actually also the downfall of traders, because the higher you go on the scale, the higher the probability, the more the risk to reward is skewed against you. And it doesn't work out in the long run, because at 90%, when you are at 90% winning percentage, many times those types of strategies, for every 100 crowns in reward, I see that you sometimes risk $1,500, sometimes even $2,000, 2,000 crowns for every $100 in reward. Guess what? You take that trade 10 times, you're going to lose money. Because the 9 times that you win 100 crowns on, yes, you make 900 crowns, and that one losing trade wipes out 2,000 crowns, guess what? You've lost money in the long run. And it doesn't matter the fact that you won 90% of the time. You've lost money in the long run. And that's why don't focus just on probability and win percentages, because it doesn't matter. Does that make sense? Please type 6 into the chat window if that makes sense to you. So what we generally find is that the sweet spot with most option strategies that work in the long run is somewhere in the 40 to 60% win rate spectrum. And when you're on 30%, you're a little too low. Many times that, the 30% you win just doesn't quite make up for the 70% of the time that you lose. And then at 70% or higher, you generally find that you're risking so much for the 30% that you lose that just those few times, many times, could blow up all of the gains from that 70%. So the sweet spot we tend to find is somewhere in the 40 to 60% range. So if your win rate is somewhere between 40 to 60%, what we created was just the probability of having consecutive losses. So at 40%, you obviously have a higher percentage of having consecutive losses than at 60%, where you have a lower percentage, probability of having a consecutive losses. Now, what we generally tell traders to do is you should always plan for having at least 5 to 6 consecutive losses at some point of your trading career. Many times this could be just going long the markets in January and then having February where everything turns against you, and all of a sudden you have 5 or 6 trades that were all long that just turned against you, right? Or this could just be a bad string of luck where the markets were really choppy, where you were trying to follow a trend, but the trend just didn't exist, and you lost on 5 or 6 consecutive trades. This is fairly common in any trading, and anyone who tries to avoid having 5 to 6 consecutive losses, again, is too focused on winning the finite game and not focused enough on the infinite game. Because again, in your trading career, you're not going to have just 10 trades, you're going to have hundreds of trades, possibly thousands of trades. Focus on that. So when you focus on potentially having 5 to 6 consecutive losses at some point, and you start planning your portfolio around that, that's when you're going to truly be successful in managing risk. So when you risk 2% of your account per trade, and you have 5 consecutive losses in a row, and I'm going to use the 50% range here for this particular example, right? So let's just say you're in the middle of the road, you have about 50% of your trades are winners. What that means is you have about a 3.13% chance of having a 10% portfolio loss. So this is 3.13% chance of having 5 consecutive losses in a row. And if I lose 5 trades in a row at 2% of my account per trade, then I've lost a 10% of my portfolio. So I have about 3% chance of losing 10% of my portfolio. Now, we said that our goal is to keep our losses to be less than 25% of our portfolio. So if we're able to keep ourselves to this particular scenario, then we have, in my opinion, a pretty good plan for making sure that we don't lose more than 25% of our portfolio. Because what this means is that I have only a 0.1% chance of losing 20% of my portfolio, right? Because 10 consecutive losses at 2% per trade is 20% of my portfolio. So I have a 0.1% of losing 20% of my portfolio, which is still within the 25% threshold that I've set for myself. So I know that this is a little bit more confusing, but I want to make sure everyone understands this. Does that make sense to everyone? You want to basically find yourself in a range where you have just a few percentage points of chance of losing that 10%, and really a very small percentage chance of getting yourself close to that 25% threshold. So please type 7 into the chat window if this makes sense to you, okay? And I'm gonna go through a few more examples that I think hopefully help solidify this if this doesn't make too much sense to you right now. Now, another way to think about this is that you can't, and you know, one of the challenges here is that we want to think about each individual game, each individual trade as a finite game, but we also have to think about how many finite games that we're playing and how they react to each other, because many times what we tend to find ourselves is that we may actually have a bunch of positions that all expire on the same expiration date. And I know anyone who's traded options here certainly has multiple positions that expire on the same expiration date. And if, let's say, you have multiple trades that all expire on the same expiration date, and they're all, let's say, long positions in the market, what you have to think about that is you have to think about those as grouped as one trade. So you can't think of those as 5 individual trades if they all expire on the same day and they're all long trades. So let's say you keep to the 2% rule, right? And you have only one trade that expires on each expiration, and you have 5 consecutive losses, then we have the example that I just talked to you about, 3% chance of having a 10% loss. But if, let's say, you risk 2% of your account per trade, but you have 5 trades expiring on the same expiration date, guess what? Now, what happened is you've actually magnified your risk by a factor of 5. Instead of risking 2% of the account per trade, you're actually risking closer to 10% of your account per trade. Now, granted, those 5 stocks will likely be somewhat not as highly correlated with each other. Maybe some stocks move higher, some stocks move lower, but generally speaking, you're increasing your risk. And it's important that you understand how you're increasing your risk, because here you're risking 2% of your account per trade and you have 5 consecutive losses in a row. Guess what? You don't have a 3% chance of a 10% loss. You have a 3% chance of, whoops, this is actually 50%. You actually have a 3% chance of a 50% loss because you've put 5 trades that all expire on the same day. So you have to think about your concentrated positions and you need to group them together. Now, I will say that if let's say these 5 trades, 3 of them were long and 2 of them as short, then you can say those are 2 separate trades. But if you have all concentrated positions in the same expiration date and they're all long, and maybe they're all banks and they're all in the same sector, then you really haven't spread out your risk. And you need to think about the risk that you have as not just each individual trade, but as a whole portfolio. So think about your trading. Are you the type of trader that, you know, has a lot of positions that expire on the same day? Are they all long? Are they all in the same sector? If you find yourself in that position, then just applying the 2% rule per trade does not quite fly. You have to think about your positions that are grouped together. What that means is that you should try to distribute your trades across different expiration dates. You should try to distribute them across long, short, across different sectors, so that even if you have, you know, one sector that makes a big move, it doesn't affect all of your positions and you don't have your risk concentrated in that one particular expiration and long, short, and sector. So I want to make sure that makes sense to you. So please type 8 if that makes sense to you in the chat window. Okay, perfect. I see a lot of 8s, and it's okay if you're not following a completely 100%. You know, I am throwing a lot of numbers at you. That's why we record this. That's why we provide the slides so that you can follow along afterwards. We are giving you a lot of information here. So I'll do the last slide that involves some numbers, and that is where you can even though you apply the 2% rule, you can actually reduce your risk a little further by applying a stop loss to your trades. So for example, you can many times for options traders, right? When we say that if you buy a call option, let's say for let's say you buy a call option for 100 crowns, right? What we usually say is that if the option declines to 50 crowns, meaning you've lost 50% of the value of the call option, then it's time to just cut your losses and move on, right? Because at that point, there's a very high probability this call option is going to 0. And you obviously don't want to lose in another 50 crowns if you don't have to. So you, generally speaking, we say that you have a stop loss at a certain threshold so that you simply just say, I'm wrong on that trade and move on. And that is a very useful tool in managing risk as well, because if you apply a stop loss to every single trade that you make, so let's say you only buy calls and puts, and you apply a 50% stop loss to all of your calls and puts, because once it loses 50%, chances are you're not going to be right on that trade. You'd rather save that rest of that 50 crowns for your next trade. And this is an extremely important way to manage risk, because in the example before, we were saying if you risk 2% of your account per trade and you have 5 consecutive losses, our baseline is that we have a 3% chance of risking 10% of our portfolio. But if we apply a 50% stop loss to our options trades, now what's happened is that even if we risk 2% of our account per trade and we have 5 consecutive losses in a row, but we apply a 50% stop loss, now you only have a 3.13% chance of a 5% portfolio loss. Now, I will say stop losses are not exact, right? Many times you might place a stop loss at 50 crowns, but by the time it gets executed at 40 crowns or 45 crowns. So generally speaking, you always have to give yourself a little bit of a buffer. So even though you intend on having a 50% stop loss, you might actually get stopped out about 60%, 65%, somewhere in that range, but still you're effectively reducing your risk. So what that means is that even if you have that scenario where you have 10 consecutive losses in a row, that 10 consecutive losses in a row will not actually account for a 20% loss. It will actually only account for maybe a 12 to 13% loss in your portfolio, half as much as what you're putting on a threshold, that 25% loss. So it's really important that you think about these different ways that affect your risk, right? Either having too many positions in a single position that actually increase your risk beyond the 2% rule, or decreasing your risk by applying a stop loss to your portfolio. So those are the different levers that you can pull in your portfolio that you can help also to manage risk and to reduce risk in your portfolio. So make sure that you think about that when you're thinking about how am I applying my psychology to playing in an infinite game. So if this all makes sense to you, please type 9 into the chat window. And again, if there's parts of this that you don't feel that you fully grasp, that's okay. That's why we record this, and that's why we make it available so that you can watch it at your own pace. And I do highly recommend, especially for those of you that have found that the concept of a finite versus infinite game is new to you, please Google it. There are so many examples that this applies to your real life that you can learn from, and then you can come back and think about it. How does this apply to your trading? Because that's how I think many times that aha moment happens, where you say, oh, now it makes a lot of sense to me. Once you learn a little bit more about the difference between a finite versus infinite game and some examples that apply to real life. So the risk per trade. So I think the best way to actually teach this is to use the OptionsPlay platform. This is the platform that you all have access to free of charge, courtesy of the NASDAQ exchange. They provide this for you, including real-time market data, so that you can actually use this to analyze your trades. For those of you that use a brokerage firm and you're using those option chains, you might find those options chains sometimes to be a little difficult to navigate. I certainly always have found those, especially for beginners, sometimes difficult to navigate, because you're just not exactly sure where do you start, what expiration date, what strike price. We built this tool from the ground up to make this process easier for you, so that you're not looking at pages like this to decide what expiration date, what strike price, what strategy. We make it very visual for you so that you can just type in a symbol, select whether you're bullish or bearish, and instantly see 3 bullish strategies on a specific stock. So for example, 3 bullish strategies here or 3 bearish strategies. For H&M, there aren't a lot of strategies at the moment, but maybe let's see another stock like Axe Food. Axe Food, if you're bullish on this grocery store, you can see 3 bullish strategies or 3 bearish strategies. We've already picked this, not only the strategy for you, we picked the expiration date and strike price. We're actually going to teach you some of how we selected these expiration dates and strike price on our next education session in 2 weeks, where we're going to talk about optimal expirations and strike prices. So I'm really looking forward to teaching that. But this applies what we're going to teach you here next week instantly on your screen, so that you don't have to use pages like this to determine where is your optimal expiration. But one of the things that this doesn't necessarily do is tell you how many contracts to trade. So for example, if you're bullish on Axe Food and you're using this tool and you're saying, okay, I want to buy this call option here for 1,400 crowns, how can I do that? What you can do is you can click on modify, and what we have is a risk and investment calculator. The risk and investment calculator actually does the work for you, where you can say, I want to risk a certain amount. Now, what is that amount? That amount is your portfolio divided by 50, or 2% of your portfolio. So let's say you have a 100,000 crown portfolio. 2% of that is 2,000 crowns. So what you want to do is you want to say, I want to risk 2,000 crowns. And when you do that, it will automatically calculate for you the number of contracts that you can trade. So here you can only trade one contract, because one contract is 1,400 crowns. If you're only willing to risk 2,000, you can only trade one contract. But if, let's say, you have a 1,000,000 crown portfolio, now your 2% rule is 20,000 crowns. So you can type that in 20,000 crowns. It will adjust that to 19, it will adjust that to 14 contracts. So this tool is actually designed to help you stay within your means or stay within your lane, but you have to first calculate what's your 2%, what's the 2% rule of your portfolio, and then you can enter it into this risk and investment calculator, which is the third dot here at the bottom. And what it does is once you click on calculate, it will calculate the number of contracts that you can trade. So here, as you can see, this is 19,600 crowns, which is just shy of the 20,000 crowns that you are able to risk on this particular trade. So we've produced these types of tools that are directly into your trading account, into your OptionsPlay account, that does these calculations for you. You just have to make a mental note to yourself, generally speaking, based on your portfolio value. So let's say you have a 2,500,000 crown portfolio, you can multiply by 0.02, and you know that for each trade you can only risk, what did I say? 2.5 million crown. Oh, whoops, I divided by 0.2. I meant 2.5 million times 0.02 is 50,000 crowns. So you know that you should make a mental note to yourself that every single time I place an options trade, I should try to exceed, or I should try not to exceed 50,000 crowns per trade. And you can use our risk and investment calculator to do this. And especially if you're trading strategies like credit spreads, right? Because many times when you're trading a credit spread, and here's an example of this. Let's say I'm trading a credit spread. And many times when you're trading a credit spread, you have to worry not just about the premium that you're collecting, but what's your max risk? Because that's the tricky part about calculating contracts, is that you have to calculate your max risk, not your premium that you're receiving. So on strategies where you're receiving your credit, this actually calculates for you your max risk, and then calculates the contracts for the number of max risk. So it's really designed from the ground up to be flexible and designed specifically for options trading. Because if you're saying, oh, so for $50,000 here that you're risking, you're actually only collecting 28,000 crowns. So your risk to reward here is roughly 2 to 1, where you're risking roughly double what you can potentially make. But what you're concerned about is not how much you can make, but how much are you risking. And that's what the calculator automatically does for you. So that is how you can take what you've learned here today and utilize a tool like OptionsPlay that applies this rule for all of your trades. So no matter what you're looking at, whether you're trading very complex spreads like butterflies, condors, or if you're just simply buying a call or a put, how you can apply this for your own trading account. So with that, that covers what I wanted to display, show you here today. So just a quick summary here. Remember, you're playing an infinite game when you're trading. Stop trying to win, because when you're trying to win, that tells me that you're trying to win in a finite game and you're not playing a finite game. Each individual trade is a finite game, but that doesn't really matter. What matters is the long game, your trading portfolio. Do everything you can to stay in your trading account. And the only way to do that, in my opinion, is to risk no more than 1 to 2% of your account per trade. And the goal to do that, for that, is to simply minimize your portfolio drawdown. your goal is not just to not blow up your account. Your goal is also to minimize your portfolio drawdown, because as we showed you, if you lose more than 25% of your portfolio, it becomes increasingly difficult to get yourself back to break even. So you generally want to plan for at least having 5 to 6 consecutive losses in a row. That's just realistic. That's what you're going to see as you trade, is that at some point you're going to have 5 to 6 losing trades in a row. If those 5 to 6 losing trades in a row push you beyond the 25% rule, then you'll find yourself very difficult to get yourself back to break even. But if you stick to the 1 to 2% rule, you won't exceed that 25% and you'll be able to continue on trading. And lastly, try to distribute your trades across expiration dates. Don't just load up on all June options that are all long, because all it takes is one bad month and now you've wiped out a good portion of your portfolio. So try to think about spreading your trades across expiration dates. And even if it's not across expiration dates, definitely try to spread them across different sectors and across long short if you have positions that all expire on the same expiration date. So that's what I wanted to cover with you here today. I really hope that for many of you that have that are learning this for the first time and seeing this for the first time, that you take from this and you try to learn more about it by going on YouTube, going on Google, because that's really how I learned about this stuff. And it was a complete game changer in terms of how you think as a trader, is not thinking about each individual trade, but thinking about the long game, which is an infinite game. And once you change your thought process on that, that's really where I see a lot of people start to change their psychology and they become much more successful at trading, because they're not emotionally attached to losing trades. They're okay with letting losing trades go and just focusing on the next trade, because that's what they're most focused on, is managing risk and not necessarily winning. Once you manage risk, the winning will come. So I hope that this was useful for you guys. And at this point, what I'll do is I'll open this up for Q&A for a few minutes if any of you have any questions. But I do want to thank you for taking your time out here this evening, because I do think this is one of the most important lessons to learn for traders. And just a reminder for those of you that have not signed up for OptionsPlay yet, you can sign up by going to optionsplay.se. So if you have any questions, please type them into the chat window. I'm happy to stay here for a few minutes and answer any questions you might have. Wolfgang, you're very welcome. Thank you so much. I really appreciate this. I've been doing this webinar quite recently here in the US and Canada. And I've recently gotten quite a few emails from viewers who, told me, thank you so much. This completely changed my view on how I think about my trading, how I think about my trading account. So I know that this sometimes can be a little far-fetched, thinking about games, infinite versus finite games, and it sounds a little hokey, but I promise you, if you take the time to learn and research this, it will be, in my opinion, extremely useful. And I will post this link here to a video that is completely unrelated to trading. It is a talk by Simon Sinek, who talks about the concept of finite versus infinite games with respect to leadership. And I think this is just a good, I would say, example of how you apply this theory to something else in real life that you might find easier to relate to, that you might then come back and think about your options trading and your trading portfolio, and kind of have a better way to apply this to your portfolio, because it is something that it's a very simple, but it's a very hard change to make, to change your trading psychology, because this is not complicated, right? But it is psychologically extremely hard, in my opinion, to make that switch. But once you realize how applicable this is to many other aspects of your life, that's when I think that psychological change, I think, is a little easier to make. So Tomas is asking, where can I see the recording? Because I was interrupted, I couldn't see the whole webinar. So Tomas, we will send you the email. We will send you an email immediately afterwards, but you can also go to our education page, which we will post it here. I'll post this link in the chat window. We host all of the recordings under the education section. So all of the educational courses, so you can see our beginner. So this was our beginners course 1, our beginners course 2. You can see all of the recordings from starting in February. So especially if you're brand new, check out beginners course 1, beginner course 2. And today we just started the intermediate course. So we'll post that link here on this website. And I just posted that link to you guys into the chat window. Any other questions? Sig said very valuable lesson. Thank you. You're very welcome, Sig. I hope that this was useful. Annika, same thing. This is, again, from my perspective as a strategist, the most important thing to learn before you learn anything about calls and puts and strategies in the market and technical analysis, because none of that matters if you're not thinking about trading from the right psychological perspective. And that, again, is that you're playing an infinite game. It doesn't matter whether you win on this trade or in the next trade. That doesn't matter. What matters is staying in the game. And the only way to do that is by managing and focusing on managing risk. Christian, you're very welcome. If there are no other questions, I just want to again thank everyone for taking the time out here this evening. Again, I hope that this was useful for you guys. We will send out the recording to you guys here in about half an hour once we finish processing it, so that you'll be able to review this along with the slides at your own pace. And again, for those of you that this is a brand new concept, I highly recommend you to do a little bit of searching on your own about the concept of finite versus infinite games. See how, there's been plenty of things that people have written as far as how it applies to other aspects of your life. And it can very much change the way that you think about lots of other things. So I recommend it highly. Even if you never apply it to trading, I think it's an important lesson to learn in life. So thank you so much. I hope you guys have a great evening, and I'll speak to you here in a couple of weeks. Have a good night.